Well, I want to thank you all for the invitation. Yeah, we had Dan down here in Athens for a couple of talks back in the days when we could actually travel and be with each other. And there are some conveniences to this business of doing it on Zoom, but it also lacks a little personal touch. So in any case, let me say I'm not an economist. I'm a retired physiologist. And I would just learn how money is created, how the monetary system works about 10 years ago, and I was appalled. And based on that sort of reaction, I got involved into the American Monetary Institute and went to their conferences a number of years. And since that time, then what happened was that Stephen Zerlanga passed away, and he was really the heart and the soul of the American Monetary Institute. And so out of that arose the Alliance for Just Money, which wanted to be more of an activist group. The AMI had been pretty much a sort of a think tank and had been one that was useful, brought together a lot of people with different ideas. But the Alliance now has grown out of that and is trying to move toward becoming more of a grassroots organization and an organization to try to influence public policy. So with that as the sort of introduction in terms of who I am, let me just go into sort of my thinking about this. And the first slide shows this interrelationship between power and wealth, which you all are undoubtedly absolutely familiar with, because what happens when people get in power, they pass laws that essentially increase the flow of wealth to them and their buddies. And when you have more wealth, then you can also influence the course of decisions of those in power. So it's a positive reinforcement cycle. And for those of us who are interested in, who are concerned about aspects of this, whether it's the concentration of power or the concentration of wealth, because they're interrelated, what we have to realize is there has to be efforts directed at both halves of this loop. And so obviously there are many organizations that are working on issues of power in terms of the concentration of power, for instance, in the corporate world. There's organizations interested in trying to get, Move to Amend is one of the ones that you probably know about, trying to get a constitutional amendment. This is corporations are not people, and that money is not, some campaign contributions is not money, that is not speech that can be free of regulation. So campaign finance policy influences power directly. Antitrust policy does. The issue of corporate personhood that the Move to Amend is working on falls in there. And of course, on the wealth side, monetary policy falls there, and so does tax policy. And tax policy is, of course, something you all are very interested in terms of the land tax idea, but I'm going to be focusing on monetary policy here, and then we can see how the two work together. Okay, the reason why I'm interested in the monetary system, because I think the monetary system does affect democracy itself through its effects on the distribution of wealth and power. And particularly, it directly influences the distribution of wealth. And you all know, you've seen data like this, I'm sure, that reflects this concentration of wealth in private hands and the distribution of wealth and debt. So here in this particular representation, what you see on the left up here, the top 1% has 35% of the US net worth and a small fraction of the debt. Even rich people borrow. As you go down, pick up the next 4%, there you got 5%, which owns now some 60-some% of the wealth and picks up a little bit more in debt. Of course, you come down here to the other end and you combine these three groups here. That's 80% of the people who have the bulk of the debt and have less than 10% of the wealth. So in this current system, what we have is money created as debt, and some people get the debt and some people get the money. So there's a quote here from Justice Louis Brandeis, which I've always appreciated. What he said: we can either have democracy in this country or we can have great wealth concentrated in the hands of a few, but we cannot have both. And what you all are aware of is we have an enormous concentration of wealth in relatively few hands at this time, and it does indeed threaten democracy. Now, what you all probably are aware of too is there are two kinds of money. There's the money we carry around in our pockets, coins and paper money, currency. So this is all the currency. And then there's account money, which we use every day. It's the way we get paid. We don't get paid in cash. It's the way we pay our debts. Increasingly, it's the way we even pay parking meters and groceries at Kroger. So all of this money that is account money is in fact created by private banks, not by government. Government does create the coins, and that's a revenue source. Not a very big one, but it's a revenue source. The bills are printed by the government Bureau of Engraving and Printing, but they are in fact sold to the Federal Reserve banks at the cost of printing them. So they don't achieve their face value until they're in the hands of the banks. So it's the banking system that essentially creates both this and paper money. Even these two together only comprise 5% or less of the money. So the important take-home lesson of all of this is that money is created by private banks, not by government. And you might raise the question, well, wait a minute, what about this? This is the Federal Reserve. But the Federal Reserve banks are in fact private banks too. The Federal Reserve Act of 1913 set up the Federal Reserve banks as private banks owned by the banks they serve. There are shares that are owned by local banks. Of course, Federal Reserve of New York is largely owned by about 4 big Wall Street banks. So they pretty much control the behavior of the New York Federal Reserve. So anyway, that's the main point I want everybody to understand. That basically, our money is created by private banks, not by government. Okay, so to clarify this thing, there are sort of two ways money can be created. Money can be created by the government, and it can be created as credit by banks. And historically, there's always been tension between these two. The private banks have always wanted the privilege of creating money. It's a pretty lucrative business. But governments have also wanted the revenue from money creation. And of course, in the back in the Middle Ages and so on, princes and so on created their own money, printed their own money. So that was essentially government created money. And more recently in our own history, of course, government, the American colonies, out of desperation because of lack of money, started to create their own money, print their own paper money. And of course, Ben Franklin was a big advocate of paper money being produced by the colonies. And also we had, and that was government created money in the sense that it was the colonial governments that were creating this money. I suppose the British bankers referred to, thought it as an alternate or a local currency, which they didn't want to have competing with British money from the Bank of England. So let's look at these two systems here. Let's look at this system on the right first. This is where money is created as credit by banks. So this is what we have today in our country. So what you see is the money is loaned into circulation. So this is the economy with money going around in all the transactions that occur as part of our economy. Now that money that's loaned is, there's an expectation that it will be paid back, okay? And that it will be paid back with a little additional money, namely the loan interest. Just looking at this simple flow of money makes you realize that the banks that have been really given the responsibility to provide our money supply take more out than they put in, because they take out the principal that they put in, and they also take out loan interest. This is a problem, of course, and you ask, well, how the hell can that work? And of course, it can work as long as the lending is going faster than the repayment. As long as the lending is going faster, then some of this money is continuing to feed into the money supply, and the money supply is growing. But you can also see if lending slows down and then repayment persists, then you can have more money being taken out by the banks than is being put in, and you can have a decrease in the money supply. And that's, of course, what happened big time in the Depression, and it's happened in other recessions as well. A decrease in the money supply, money hard to come by. So in this case, money is created really as debt. That is to say, all the money is introduced into circulation as a debt, or the bankers would like to say as credit, because it sounds nicer. But the other half of credit is, of course, debt. Now, money created by the government has kind of a different course in the sense that, the governments typically spend money into circulation, okay? Now, they take some out in taxes, and a lot of that essentially goes back into spending, like government does, for everything from infrastructure to, well, government spends on a lot of things. But one of the differences here is that the money that's created by the government, it's like coins. It stays in circulation. Stays in circulation just forever. It's not being taken out regularly like loans are being repaid. Now, some is taken out as the coins wear out and they're replaced by the banking system, of course, and some is taken out in taxes, but that's typically returned to circulation. So that's then the difference. But what you can see here is that this money is created without debt. Nobody goes into debt to get this money. It's spent. It's spent into circulation to pay for the things that government pays for. It's employees and contractors and services and whatnot. So here, money is created, it's created as money. It's not created as debt, not created as credit. It can be regarded, it can be regarded as a public asset. So it's created as a public asset rather than as public liability. Okay, I wanted to throw in a quote here from David Ricardo. This business, in part because Ricardo is important, as I understand it, to some of the Georgia's thinking with regard to economics. And Ricardo on banking knew clearly, and of course, Ricardo lived, I guess he was more or less a contemporary maybe of Andrew Jackson. He was born in, I think, 1772, something like that, and lived into about 1830s, something like that. So he understood very well this business of the idea of whether that money can be created either by banks or by government, and understood the consequences. So here, he says it's evident, therefore, that if the government itself were to be the sole issue of paper money instead of borrowing it from the bank, and here he was referring to the Bank of England, the only difference would be with respect to the interest. The bank would no longer receive interest, and the government would no longer pay it. But all other classes in the community would be exactly in the same position in which they now stand. Well, we can question whether or not things would be in exactly the same position if we made that switch, because the economic and monetary systems have become enormously complicated, more so than they were in Ricardo's day. But what I want to point out, and this is something you're probably all familiar with too, is that what are the consequences of this current money system? And one of the things I'm not talking about today, because it gets into the weeds a little bit, is precisely how is it that banks can create money and other non-banks can't. But that's another discussion for another time. And if you want to talk more about that in the question and answer period, we can. But I want to summarize here that what we have as a consequence of the system, we do have this concentration of wealth in private hands. And of course, the principal driver of this in this bank money system is the fact that there's interest paid to the bank on every dollar in circulation. Now, it turns out that's a lot of money, even with low interest rates. So this is basically a mechanism of transfer of wealth from the many, the users of the money, to the few, the lenders who create the money. Then there's a second way that this bank money system concentrates wealth, and that is the fact because government is not creating the money to make up the difference between taxes and spending, it borrows. And of course, it pays interest on what it has borrowed, what the government has borrowed, and that's the debt service of the federal government. That is the third largest item in the federal budget, paying the debt service on all the various borrowing that the government has done. Of course, the way government borrows basically is by selling treasuries, treasury bonds, treasury bills, and so on. So because we have banks creating money instead of government, we have this rising government debt, which is really going through the roof at the present time, as you all know. And the other thing, particularly historically, oops, I didn't mean to do that. Let me go back. Is we have a kind of austerity of government because government is not creating money. So every time an expenditure comes up for social services, for instance, whether it's Medicare or any one of a number of things, the question always arises, can we afford it? So we find the government, which could create its own money, finds itself limited by the lack of money, which makes no sense. There is no reason for government expenditures to be limited by lack of money when the government itself, according to the Constitution, can make its own money.
I just wanted to mention briefly that people on the left dislike austerity because government could spend more money. People on the right would say, well, we could have far lower taxes, but we could have either one. That ends up being a policy decision, whether we want a lot of government services or we want very low taxes. But this allows us to have lower taxes and or more services.
Yeah, but the thing that this raises the question of what should limit what a society can do. And what I'm suggesting is it shouldn't be money because government can create its own money. What the limits that have to be imposed are limits that naturally occur, limits of labor and limits of resources. So you can't create more money than you can use without having an inflation. That is to say, if you have just money willy-nilly created and you can't use it to pay for labor and resources because they're not available, then that is the recipe for inflation. But where government expenditures essentially produce an increase in goods and services, then you don't have the danger of hyperinflation, at least, that you would otherwise do. So there are limits to what expenditures a society can make because there are limits of its resources and labor. The limit should not be money. The government should create the money and to do what it needs to do in whatever political ways it decides to do it. And we can talk about that later. And the fourth thing, the consequence of this system is this unstable economy because what you have is a system that is in sort of engineering language, a positive feedback system, or a pro-cyclic system, it's sometimes called in economics, where when things are looking good, banks are eager to lend because they know the borrowers are going to be able to essentially use the money in a way that's going to allow them to get paid back. And borrowers are willing to borrow because things look promising, and they'll be able to use that money to start a business, and they'll have customers, they'll have some money that'll be able to pay. So it feeds on itself. And this tends to result in higher and higher risk lending and the accumulation of more and more debt. And then when things get a little shaky, as you know, then people are less willing to borrow, and banks are less willing to lend. And now we get this feedback that results in a decrease in the money supply because of the decrease in lending. So what we see now is this, the realization that when things look bad, in fact, there is a need for government, in fact, to spend. That's the dominant philosophy that's running in Washington now. And this is a reversal of, for instance, the classic economic doctrine that led the Federal Reserve back in the 30s to essentially clamp down on money to control the economy. So this unstable economy is obviously bad for people, because when we go into a depression, people lose jobs and suffer. And it's bad for business because it's hard to plan. When you don't know whether you're going to have customers or not, they're going to have any money to buy your products. So these are the currents, the consequences, at least as I see them, of the current monetary system. So we could just briefly mention that about various alternatives, and there are many out there. But I've highlighted the first one because this is real monetary reform that would transfer the issuance of money from the private sector to government, from banks to government. Okay, that's real monetary reform. Other people have different ideas that essentially operate within the existing system. A public banking idea, the Bank of North Dakota model. A lot of people are big on that at the present time. And public banking is probably might be helpful to Los Angeles or Philadelphia if they actually go through with it. But the fact is, it won't change the debt money system that we have. It does little to influence the concentration of wealth. You would have to have the entire system become public, and that would be like nationalizing the banks. And I don't think many of us want to go there. Although Ellen Brown, who wrote the book Banking on the Public, sort of conceded that that would be the logical extension of public banking, would be the nationalization of banks. So that's one that's out there. Complementary or alternative currencies, and we're deluged with this information about Bitcoin and other monetary systems. So we could talk about that, but you know, there are sort of three things that sovereign governments do. They declare war and raise armies, and they collect taxes, and they provide a monetary system. And they've already given away the monetary system to the banks, but I don't think they want to see the monetary system being taken over by the private sector altogether. And so there's a lot of effort, particularly among central bankers, and that's sort of down here, to generate their own digital currencies in competition with such things as Bitcoin and others, so that they can maintain some control over the money supply in general. You may have also heard of modern monetary theory. Again, this is, I summarize it rather briefly here: ignore the deficit and just spend, which some people say is what's happening in Washington at the present time. And some people talk about the return to the gold standard, which is, in my view, an absurd thing to suggest, since we tried that already and it didn't work because the gold supply didn't keep up with the growth of the economy. So the real monetary reform was really came out of the Chicago plan, which is put forth back in the 30s to go to 100% reserve banking, and the rationale, of course, was that with the fractional reserve system, the banks only had a small amount of sort of reserves and cash, and when people got worried about it, they all went to the bank and wanted their money back, and the fact is they couldn't get it because the banks didn't have it. So the proposal basically was to say, look, banks, if you're going to take these people and guarantee that they can have it on demand, you got to have it. You can't lend it out. And the proposal really implied that the banks would have to change their business model, and they could take money specifically for the purpose of lending it out, like investment banks do. And that's the way banking should be done. And that was proposed at that time. And then it was picked up essentially by Stephen Zarlenga, and he got Dennis Kucinich to introduce this NEAT Act, National Emergency Employment Defense Act, in 2011. The focus of this, of course, was a pathway to the recovery from the 2008 recession, which hit hard and simply didn't provide the kind of standard time course of recovery that economists expected. And what the NEAT Act did, it specified three things: a government creation of new money by spending it into circulation. And so it set up the machinery within government through a monetary authority, which would presumably determine how much money was appropriate to spend and somehow limit congressional spending to that. The second feature would be ending bank creation of new money altogether, so through fractional reserve lending or in any other way. And finally, ending the Federal Reserve System, because one would be taking essentially the function of checking accounts, of transaction money, and directly, it would be backed up directly by the Treasury Department, by the government, so that you wouldn't need a separate Federal Reserve System, and there would be no sense in having it. So that was the proposal that Zarlenga initiated, following up from the work of early economists, and then Kucinich put into a bill, which of course was ignored in Congress. There are fiscal issues associated with the NEAT Act, and as Dan just pointed out, there are people who see the NEAT Act from a more liberal perspective as a way to enable the government to do these various programs to solve the problems that they see out there. And a more conservative view is that you can't trust the government to do it right. We all know government can bungle at times, as do all big organizations. So it's safer to just give it to the people. So the NEAT Act, in fact, acknowledged both of those things, and it made one of the things it specified was that 25% of all the new money that government creates has to go to the states. That was a way to disperse it, to make sure, and that was on a per capita basis. So it was to distribute it among the people as equally as possible. And it also then made a number of recommendations for Congress to consider. And some of them were favorite programs, and some of them, and one was the idea of a basic income. So the NEAT Act essentially acknowledged both of those points of view. And obviously, within the monetary reform community, there are people who favor one a little bit more than the other because of this range of people across the political spectrum, all of whom know that the system needs to be changed. And another kind of fiscal issue of the NEED Act, that there's a lot of debate among people in the monetary reform community, and that's just how taxes will be affected. There are some folks that think that tax can be reduced or even eliminated with government creating money. There are others of us that think that that's simply can never happen. And it's not very constructive to think in those terms. But anyway, that's another issue that we could talk about. Another issue that's associated with monetary reform has to do with shadow banking. There was a very provocative book published by a couple of Swiss people in the financial industry there. It was published under a pseudonym of Jonathan Macmillan. And he basically said, yeah, this idea of full 100% reserve banking, more or less like the NEED Act does, although he didn't refer to the NEED Act, he referred to the positive money version of it, which at that time was virtually identical to the NEED Act, but that was the British version. But what he said was that, well, a lot of the money that's being created these days is created by shadow banks. And so if you don't do something that essentially addresses this money creation by shadow banks, if you only focus on the banks, as the NEED Act does, that won't solve your problem. So there is this question about what would happen if, in fact, you did do this transformation of money creation from the private sector to the public sector, what effect that would have on this whole superstructure of the shadow banks, in which they take money, most of which is created by banks, as they make loans. They're loaned into the financial sector, where they get loaned on again and loaned on again. And this is the shadow banks, which basically are borrowing and lending. And the question is, in doing that, are they just using money that has been created by the banks, or in fact, as they do that, are they creating money? And the final thing I'd just like to refer to, and that is, I think you probably will all recognize that, you know, we have a growth problem on a finite planet. You can't, on a finite planet, you're not going to be able to just continually increase the rate of consumption and waste production because you'll, well, as what's her name, who wrote the book about the donut, the donut theory. I can't remember her name. Doesn't matter for now. But the problem is that the current monetary system absolutely depends on growth, because the bank system only creates the money that expects to be returned as repayment and doesn't create the interest. So there's always this drive then out there to make some more money to be able to pay back the interest. And that all has to come ultimately from the only source of new money, and that's new loans. So, and so the present monetary system drives this inflation, it drives this growth. Inflation, of course, is planned in. It's 2%. They want inflation because they know it has to be part of the system for it to be sustained. But it's an unsustainable system in the long view, because it is completely incompatible with the idea of a steady state economy. Steady state economy in our current system is just at that threshold where you can go into a depression. And that's why the banks always want to stay away from that, by having this growth occurring, and with it the inflation. Okay, well, I think that's, why don't I just stop here and then and see where we go from here. And I'll stop sharing.
Yeah, I wanted to talk about the history of this a little bit, because it is a very Georgist history. And I wanted to say briefly that shadow banking does create money, but we can treat that money exactly the same way that we treat foreign money. In other words, if you create, if a company creates credit backed by that company, AIG or somebody creates credit backed by that company, that's perfectly fine if that credit has that company's name on it. But you cannot deposit that money into a US dollar bank account. That would essentially be counterfeiting.
And you
So
can't pay, and you can't pay your taxes with it.
where you can't pay your taxes with it, but you also can't pass it off as money, as US money. So it would be exactly the same as Canadian money or British money or whatever. And it's fine for the people who want to accept that money, but it would have an exchange rate the same as foreign currency has an exchange rate. And if they overinflate the AIG credit money, the primary sufferers would be the people who hold that instead of holding US money. So that would be the main thing. But I want to
let me just add something to that. I agree with you fully, what you just said. I kind of look at that money that's created in the shadow banking as an alternate currency. And that's essentially equivalent to what you've described.
Yeah, it pretty much is. So anyhow, what I wanted to talk about was the progressive movement was very much based on two major economic reforms. One was the Greenback movement, which is very similar to the Chicago Plan and very similar to what the Alliance for Just Money is advocating today. And the other was the single tax movement, which was Henry George's movement. And the progressive movement grew out of the abolitionist movement. The first people to call themselves progressives were the Society of Progressive Friends, and which is a Quaker abolitionist group in Lancaster and York, Pennsylvania. And I searched old periodicals for the words progressive, and this was some time ago. I'm sure there's more examples than there were. But the only time I found it in a political sense was that, and then the Steinway Piano Company was considered a progressive company because they paid their employees well and they treated them with well. And then there was a southern town after the Civil War that was referred to as progressive because they accepted the Union, they accepted the abolition of slavery, and they embraced it and tried to make the most of it. The Free Soil Party, which was anticipated the Republican Party, called for no more giving land to giant corporations. Land should be reserved for homesteaders, and it also had something that would separate the government's monetary system from that of commercial banks. So they didn't have the economics worked out, but those were things that kind of grew in tandem with the abolition of slavery. And the approach of the progressives were basically, if there's an injustice, you find the underlying privilege and you abolish that privilege. And two leaders of the progressive movement were Terence Powderly, who was the head of the Knights of Labor, and Henry George. And the word progressive took off. Google has something called engrams, and that shows what percentage of the language it uses that word. In other words, of all the words that existed in a particular year, what percentage of those words were progressive, were the word progressive? And it went up very quickly in the 1880s, right after Progress and Poverty came out. But I wanted to talk about, first of all, the Knights of Labor's platform on money. And it says, the Knights of Labor's platform was to prevail upon governments to establish a purely national circulating medium based upon the faith and resources of the nation, without the intervention of any system of banking corporations, which money shall be a legal tender in payment of all debts, public and private. And we get into the question of whether the land question is bigger than the money question. So we get this, in my opinion, the main all-absorbing question of the hour is the land question. Make your currency of what material you choose, but if I own the land, you cannot base your currency upon the wealth of the nation, for that wealth is the land. You may make laws and own the currency, but give me the land and I will absorb your wealth and render your legislation null and void. Now, you would expect that was Henry George, because Henry George, that was his position, but that was actually Terence Powderly. That's a quote from Terence Powderly. And in that little ellipsis there, he says, and did I allow this opportunity of expressing that opinion to the Knights of Labor to pass by without taking advantage of it, I would prove myself false to my own convictions of right and justice. The 8-hour law, the prohibition of child labor, the currency question are all of weighty moment to the toiler, but high above them all stands the land question. Give me the land, and you may frame as many 8-hour laws as you please. Yet I can baffle them all and render them null and void. Prohibit child labor if you will, but give me the land and your children will be my slaves. So this is something that that was widely seen by people in the people in the Greenback movement. Saw the, and he said this prior to, he said this in 1878, I believe. Yeah. So people saw the land question as very important before Progress and Poverty came out. They just really hadn't nailed down the answer. And the thing that binds them all is that these are privileges. And privilege is a contraction of private legislation. It's any law that gives some people a benefit at the expense of other people. And so I'd like to look at the parallels between the land question and the money question. Landlords rent us what is rightfully our own land in the first place. Now, it's not our own land individually, so landlords still provide a service in that they decide, you know, the private market gets to decide who gets the land, but ultimately it's not their land, it's everybody's land. And that's a central Georgist concept. Well, bankers lend us what is rightfully our own money in the first place. So, you know, they are enjoying a privilege of creating the money that is the common currency of everybody. Land value comes from the quality and productivity of the people, mostly near the land in question. And money's value comes from the products and services available everywhere that uses that currency. So the people who create the products and services are creating both the value of the land and the value of the money. The difference is that the land value is very local dependent, and the currency value is very it's universal across the area that uses that currency. People will say, well, you don't have to own land. You know, that's what the frequent objection is. Well, you're making this land to be more important, but you can make money as a computer programmer. But you have to rent land from someone who does, and you have to work for someone who does. And the products the computer products you're selling, the consumers of those products have to have land too, and they have to eat, and they have to have places where they can do what they do. So it doesn't matter if you personally have to own land, and you personally don't have to borrow money, but you can't get money unless you get it from somebody who borrowed it. So there's another parallel between the land and money question. Land has to fluctuate in value because the supply is fixed. Money has to fluctuate in supply so the value can be fixed. The point of money is that people will trust that it has a constant value. Another difference is that with land, every parcel's value is unique, but every bill's value is standardized. All the money has to be of the same value for the money system to work. Land is regulated by local governments, which is great for us because we can win at the local level. The money reformers are in a bind because if Congress doesn't do it, there are a lot of things that inhibit a local or state government from doing it. The Constitution doesn't allow local and state governments to make anything into money except gold and silver. And there are ways around that with a land trust kind of thing, but they're complicated. But I think the money reform will probably not occur in the United States until it occurs in a small country, because a small country that's not dominated by banks is maybe the most fertile ground. You can't live without land, and you can't pay taxes without money. So even if we had a land value tax, it would stop the landlords from oppressing us, but you would still have to go to the bankers to get the money to pay the taxes. So the two things run hand in hand. Now, what do we propose? Well, George has proposed that land rent should be used to replace taxes on productivity, or should be distributed to the society on a per capita basis. And the money reformers say that new money should replace taxes on productivity, or should be distributed to society on a per capita basis. So this is another parallel. Now, we had we have a kind of a my reform's bigger than your reform thing, which is unfortunate. And it began with what I think is a glib quote from Henry George. He said, well, suppose you had all the money in the world and I had all the land in the world. What would you do if I were to give you a notice to quit? Which is kind of a glib way of doing it. And I would say, well, you can't pay the sheriff's fee. You know, the sheriff, if you want the sheriff to come and evict me, he charges a fee. So I can be equally glib and say, if you have no money to pay the sheriff's fee, then I don't care what you give me notice to do. But the fact of the matter is that it's never that some people have all the money and some people have all the land. The people who have the land are the people who created the banks. And once banking began, the landowners who became bankers quickly became the biggest landowners. So the Duke of Buccleuch today is Scotland's largest landowner. Well, why is that? Well, it's because in the 1700s, this Duke of Buccleuch went into banking. And Scottish free banking was dominated very much by the Duke of Buccleuch. And he funded Adam Smith. So Wealth of Nations was written by Adam Smith with funding from the Duke of Buccleuch. And he was very good on the land question, but not very good on the money question. And Stephen Zarlenga hated Adam Smith, and I loved Adam Smith, but it's because on those two issues, Adam Smith was... he did not trust the government to create money. And that's an issue that we have even now. So that's basically the parallels that we have between the land and the money issues. And so I think we only have 10 attendees. And what we were talking about doing was normally we have people submit questions by on the Q&A, and we were talking about the people who are sponsors who put up money get to be upgraded to panelists. But I would say that that since we only have 10, we can just upgrade everybody. So let's let me see how to do this.
I'm doing it.
Oh, okay.
Let me do it since I know how to do it.
Okay.
I'm adding everybody to a panelist one by one. Jim
Okay.
Preston has a question right now.
I thought there was a way to do them all at once, but
nope.
Okay, and I don't know if we can get everybody's, if the camera setting might not work, but we can hear you even if we can't see you.
Alan Ridley and Jim Frederickson are the first up with questions.
Okay, Alan, what did you want to say?
Yeah, I just wanted to ask more about the government created cyber currency and which governments are doing it and what do they call it, and is it really an alternative to Bitcoin and so on?
Well, I'm no authority on those things, but let me just say this. Let's see, I can go to gallery view here, can't I? Right. There's a big sort of response to the private cryptocurrencies on the part of central bankers, because the central bankers see this as a possibility of their losing control, most of which they've already lost anyway. So the counter to that is that the central bankers want to create their own digital currencies. So in competition with these others, and of course, if they have the blessing of the state, those digital currencies can be declared as legal tender and used everywhere, including for payment of taxes, and in a position to dominate. So it's true that the Chinese are starting a digital currency on their own, in which essentially everybody has an account with the central bank instead of with individual banks, and there are individual banks around China, just like there are in this country. So this is a way to shift money from the banks, essentially, reducing their deposits. So the bankers essentially are somewhat threatened by this, because if you reduce their deposits, that reduces their liquidity, and so they think that limits them in terms of lending they can make. The discussions in all this area, in my view, are extremely murky. And to what extent is the central bankers really thinking that, yeah, let's just get rid of banking in the traditional sense and just go to a central bank? Nobody really says that, but it's sort of implied. So in any case, I really think that the Bitcoin is something that was just described by Dan perfectly well, just like currencies that are produced by shadow banks. This is another currency that's an independent currency on its own. But these currencies essentially have to compete with one another. And there was a wonderful article by Joseph Huber not too long ago on the history of how currencies evolve. And what he pointed out is that the evolution of paper money came because of technology, and it was more convenient to use. Then paper money was created willy-nilly by banks all over, and the idea of let's centralize that, and that gave rise to central banking, and particularly the Bank of England. And so what they were doing then is they were essentially creating all the money, so now we have that system of bank-created money is being threatened because it has become rather dysfunctional in a broader sense of what it's doing to society. And it's being challenged, of course, by the cryptocurrencies, who would like to have their own essentially currencies, so that then have the government out of it. So the political aspects of that, in terms of political philosophy, and the practical aspects of that, as a matter of fact.
I don't think it matters. I think that we had coins, we had paper money, we have checking accounts, and which are just electronic bits in a bank account, and the forms don't really affect the substance. The substance the real central question is the money loaned into circulation, or is it spent or given into circulation? And if it's spent or given into circulation, then we don't have debt slavery. And even, you know, the thing about cryptocurrency is very similar to the thing about gold, which was that, you know, the good thing about gold in the early days of US gold mining was that there weren't massive, they hadn't discovered massive veins of gold. Everybody would pan riverbeds for gold. And so the gold currency was like a ritual labor currency. You went out to the stream, you did this ritual, which was in itself useless, and you pulled out this gold and you took it to an assayer, and they gave you a receipt for it, which was money. And that worked well enough because that gold, there was no debt. You did the labor and you got the money, and the other person got the gold, which whatever he wanted to do with it, you didn't owe him anything anymore. So it was a debt-free currency. Where it went wrong is that there was never enough gold, and that the banks were lending money that was backed by the promise of exchanging for gold that they didn't actually have. And so the whole system quickly broke down. And it also ceased to be a labor thing, because 1,000 prospectors would go out and labor, and 999 of them would come up with nothing once the riverbeds panned out. And the remaining one person would hit this massive vein of gold and become enormously wealthy. Well, he didn't spend that money. He took that money and created himself a bank and started lending that money. So then we were back into debt money under the gold standard. So it's, you know, it was a ritual labor currency. You took the gold out of a hole in the ground and you put it in another hole in the ground, and you got a piece of paper for doing that. The indulgences in France that Martin Luther, I instinctively say Martin Luther King. When the words Martin Luther come out, King wants to follow it. But the original Martin Luther was protesting the use of indulgences. But where indulgences arose was that these monks hand lettered these gorgeous little pieces of paper that the people would be given those pieces of paper if they crawled up, if they went up the steps of, I forget the name of, there were several of these, but they went up the steps on their knees. And you couldn't do this that quickly, or your shins would be horribly bruised. So you would take a step, and you were supposed to pray a little bit, and then take another step. And when you got to the top, you were given one of these indulgences. Well, these indulgences began to circulate as money, and people were trading them. And so the monks realized that, well, if they're circulating them as money, we can circulate them too. And this was looked at by Martin Luther as selling indulgences and preying on the superstitions of the people, that they could go to heaven by buying indulgences from these people. But the people weren't superstitious. They bought the indulgence because they could take the indulgence to a merchant and get something else for it. So the indulgence were a form of ritual labor money. And what Henry George and the Greenbackers and the Chicago Plan people are proposing is, why not just give people money for labor that is not ritual money? Why not give them money for building a bridge, or maintaining a road, or teaching school children, or whatever? So that's what that concept was.
The next question is from Jim Frederickson. Jim, you want to ask your question that you posed in Q&A?
Well, I was going to read it, but I can't find it in the Q&A, so I'll try to remember exactly what I
Want me
wrote.
to read it since I can see it?
That would be terrific.
Yeah. Does Mr. Powell think that if urban taxing bodies eliminated the real property tax on improvements, and in a revenue neutral manner, raise the tax rate on all taxable sites. Less wealth would be concentrated in private hands.
So, yeah, if we went from a property tax, he's saying if we went to from a property tax to a land value tax, would that reduce the concentration of wealth?
John,
Well,
you got any comments on that?
I think maybe you folks have thought more about that than I have. So I don't really feel competent to ask that question. You know, I'm impressed that what has happened there in Pennsylvania in terms of your ability to decrease land speculation. So in that sense, yeah, it decreases wealth concentration. So that's the only example that I know of to try to cite that that would substantiate that.
Okay.
There was one gentleman who's left, Gordon Sim, who asked, "What happens if the Chinese now stop taking?"
Well, can Gordon speak?
He's not here. He's left.
Oh, okay.
So it says, will the Chinese now stop taking U.S. gifts and bonds in exchange for goods? The Chinese are starting their own crypto now. They have gotten almost all of the world jobs and big buyers of gold. This puts them at a big advantage over other countries. Therefore, what is there to stop the finance market from going into free fall? And Gordon's in the UK, so it's a little bit late there. He actually posed this question earlier today.
You're going to bed.
Yeah, it's about 2 o'clock in the morning there.
Right. Yeah. Well, that's a tough question, you know, one of the implications of monetary reform is that the U.S. will no longer be making available the treasuries. So it's true that the Chinese, as well as other countries, Japanese did this too, have in fact bought a lot of treasuries because, in a sense, what else is there for them to do with the money? They get this money coming in, dollars coming into to China or Japan earlier, and because of all the imbalance of trade. So people who are getting these dollars go to the bank and say, well, I want some local currency here because I want to buy groceries. And the net result is, of course, the banks take in the dollars and create more of their own currency in order to pay this. And so the banks, foreign banks, have got a lot of these treasuries, and what are they going to do with them? Basically, a lot of them have been held by foreign banks, and they regard this as a reasonable sort of investment. And you know, because a lot of people buy treasuries because they feel it's a safe investment, backed up by the U.S. government. So that's if treasuries are no longer available for people to put their money in, the question is, where does that money going to go? And
productive investment is the
precisely. It will be invested somewhere else. And you know, and the idea is, if you look at it just domestically, and I know that's not the context of the question, but if you look at it domestically, there are people in this country who buy treasuries. They're going to be able to buy treasuries anymore. Where are they going to put their money? And presumably, what would evolve would be essentially a market in which they would essentially loan this money to lenders specifically for the purpose of lending. That's what investment banks are all about. So that's why this money would then find its way into various investments through investment banking.
Yeah, it would be productive investors or land speculation, and that's part of why these two reforms go well together, because if we stop them from buying, if we no longer are selling government bonds and people want a safe place to park their money, they're inclined to buy land. And as we all know from the California experience, they're going to buy land where it's taxed the least. So if you shift to a land value tax, you cut off both alternatives to productive investment, and they put their money into productivity. I'm going to post the link to the Chicago plan, because I have it on my website, as written by Paul Douglas. This was his 1939 version, so by then it had already had thousands of economists approving it.
I would point out that Paul Douglas too was a Quaker.
Oh yeah,
Yeah.
but I wanted to say something about the mechanics of this, is that of the plan is that the first thing government would do is say, okay, the commercial banks have created, I think right now it's about $15 trillion. There's about 15, might be more, of money in circulation that was loaned into circulation by private banks or by commercial banks. And so what government says is, if you want to continue lending money, you have to purchase government bonds equal to $15 trillion. And we'll give them to you at, this is a one-time deal, we'll give them to you at 0 interest or an extremely low interest, so it doesn't, hurt you too much. But over the next 50 years or so, you have to pay that $15 trillion back. And from that point on, you can only lend from deposits. So now we have $15 trillion that is a positive for us. That $15 trillion, as government bonds come due, we pay the government bonds off with that $15 trillion, and we don't issue new bonds. And all additional money that goes into circulation goes directly to the people. Well, how do the banks get money? Well, if you're giving money directly to the people, some of the people are going to save that money, and they're going to save it by putting it into banks. And if they put it in a checking account, the Chicago plan is that checking account is not lendable, because if I have that money, if I can write a check whenever I want, that's still my money. It's not money that has been loaned to somebody else. If I lend my money to somebody else directly, I don't have it. Well, if the bank wants to, and this is the legitimate function of banks, the good thing that banks do is they take my money, or what they should be doing is they should be taking the money of people who trust it to the bank, and the bank should be vetting who is a safe borrower of this money, and they lend that money on behalf of all the people who deposit money. So they're kind of like an insurance company in that they pool the risk, but they're also a credit evaluator in that they give access to that money to the people who are most likely to be able to pay it back. And so that's the legitimate function of money, of banking. We don't want to get into that. That's part of the problem we have with public banking, is that public banking has the bank doing, or has the government doing something that is rightfully a private sector function. What we want to get is what is rightly the government function, which is to create the money in the first place. So that's a structural thing, but that was the one thing I wanted to link to. And then the other thing I wanted to link to, Stephen Zarlenga wrote a paper called Henry George's Concept of Money. And it's a long paper, and it has a lot of, at the beginning, it has a lot of opinions about Henry George. But the link I'm going to, and they're not bad opinions, it just seemed to be kind of pedantic, but he gets right into the meat of it. The link I have is where he starts actually quoting Henry George on money, and he gets right into Henry George's views on money. So I just put that in the chat too. And if you click on those in the chat, it'll come up on your web browser and you can see those things. Did anybody else have questions? I think
we've covered everything that I see in the Q&A. I did send you the question. You do need to spell the name of the Scottish Duke who funded it.
It's not an easy. Let me see if I can look at my. I think I have it spelled on my B-U-C-E. I'm sorry, B-U-C-C-L-E-U-C-H. Bouclé.
Why don't you type that into chat for people?
It's not easy to B-U-C-C-L-E-U-C-H.
All right. Does anyone else have any questions?
You know, I'd like to add something, if I might.
Sure.
There you got the spelling. This book, The End of Banking, is an interesting volume because you know, a lot of us in monetary reform are sort of progressive types who come into this from the point of view of almost social justice. And the authors of this book are coming from a very different point of view, even though they end up sort of the same place. They basically argue that the banks are not only no longer needed because of what technology offers, they are now simply in the way and a big drag on the economy. And they don't specifically say so, but I think the implication is they realize the social injustice of this concentration of wealth that occurs too. But they argue that, for instance, what you just described, Dan, about the legitimate function of banking in terms of this kind of thing, what they argue is you don't need banks to do that in this modern era, that there's peer-to-peer lending, and because you know, lending always used to be this careful analysis of the credit worthiness of the borrower. Now it's almost all on sort of hard data. That is to say, credit histories and so on. And that is all information that can be transferred quickly, you know, through the internet and so on. And essentially, the decisions can be made by algorithm using this kind of hard data. And you really no longer need the bank as the decider of who gets the loans. It can be decided in a more objective way. So they argue that banks aren't necessary for that, and you don't need banks for payment systems because there are already other payment systems out there existing. So it is sort of an exchange of credit systems. There's a long history of that kind of thing. So what they argue, technology has made this all possible. So you can, you know, even a private person like you and me, who, in terms of, we got a little bit of money and we want to put it into some, want to lend it because maybe we can get a few bucks, you know, in terms of interest. Well, we can go through people who can essentially match up borrowers and lenders, again, using sort of algorithms and large numbers, because now technology allows you to deal with vast numbers and vast amounts of data, all of which can be churned through quickly. So here's this, and that book I think is compelling in its arguments about that. And the thing that bothers me about that book is his conclusion that the shadow banking system would be unaffected by the Need Act, for instance, by simply changing the banks. Because what he points out in the book is that basically all this stuff does start out from money creation from banks. And he uses mutual money market funds as an example that, well, now you can put money into money market mutual funds, And of course, the money that you put in there is pre-existing money. It goes in and they lend it out to somebody else. So it goes out. But what is argued is that people use these shares, these pieces of paper that say, yeah, I've got this much money in the money market, and that becomes exchangeable, much like your description earlier, Dan, of what becomes exchangeable in terms of the indulgences. Well, these money market funds become exchangeable. And so they argue that this is money creation. And Joseph Huber, who's another authority in this business of monetary reform, he takes a sort of a middle position. He says, well, it's just that they don't create money in the same way banks do, but they're creating a lot of money. It's enormous amounts are passing through their hands, so you can't sort of ignore that in terms of the consequences of whatever sort of thing you do. But I would like to find an economist who would explore, the hypothesis of, well, what would happen to shadow banking if you had a monetary reform? And need somebody who can analyze that kind of stuff to begin to provide some answers.
Yeah, I mean, shadow banking is basically IOUs.
Yeah.
But they are not IOUs that are backed by the full faith and credit of the United States government. So they are just like, like any other alternate currency. One thing, before we wrap up, the one thing I wanted to emphasize was the difference. You touched on it in your presentation, the difference between real monetary reform and MMT, which is called modern monetary theory. And it is, throughout, as long as I've been involved with the Georgists, I've noticed that every good idea has a bad left-wing version and a bad right-wing version. And so the bad right-wing version wants to take away all the power from government and leave it with the banks. They want to go back to a gold standard and stuff. And the bad left-wing version wants to ignore what the banks are doing and just have government spend money like mad, which is what we're doing right now. And inflation just went up to 4%, and it promises to keep growing. And the thing I want to point out that's wrong with MMT is that they ignore the bank's response. When government creates more money, the banks say, oh, since there's more money, people will be able to pay back loans. So what creates the inflation is not just that the government is creating too much money, which they are, because they aren't curtailing the banks in the process. But the big thing is that this government money gets magnified by bank credit. So where's the inflation? Richard Vague, we have another, if you look at our CGO videos, we have one on Richard Vague, and he said he studied, I think it was 40 some major crashes over the past 150 years internationally. And every one of them had an asset bubble before the crash.
Right.
And we're creating asset inflation, not consumer price inflation, but now consumer price inflation is following. And the asset inflation was, well, all these people had money, but they were all dressed up and no place to go because of COVID. So what are they going to do with that money? Well, they'll put it into stocks, they'll put it into bonds. A lot of people are saying, if I have to work from home, I need a bigger house, because I'm really cramped here working at my kitchen table. It was okay when I spent 8 hours at work and then went out to a restaurant. I can't do either one anymore. I need my kitchen for cooking. I need a room for doing my business work. So housing has started going up abruptly. Just at, housing was supposed to peak in 2023 anyhow, and then crash around 2026. And we're giving it a big shot right when it was headed for the peak. And the price of lumber has gone way up because people, because they're building more. and they're building more at a time when the sawmills and the lumber yards and all those people were on short staff because of the COVID restrictions. So they weren't working as closely together, and they're putting out the lumber more slowly. So now we get this big inflation. And it's not that the MMT people were entirely wrong. It's that their big error is that they ignored the banking response to creating more government money, because they don't have the courage to take on the banking privilege. They just want to, they want to spend more money. You know, they're very left wing. MMT people are more left wing than monetary reform people. And they wanted government to just spend more money, and they thought it wouldn't matter because productivity would increase. And what's increasing is the price of land and stocks and other assets. So that's the thing I want to emphasize, is that, you know, it's another parallel between the Georgists and the monetary reformers, is that in this polarized world, nobody wants the middle common sense approach that actually stands up to privilege. You know, Henry George described something like this as wanting to get on the good side of God without angering the devil. And you can't do that. You're not going to, if you want to do what is right, and if you might not be religious, just take it as a metaphor. You cannot do what is right by God or by justice or by poor people without doing what is wrong by the devil or by privilege or by very rich people. So, you know, that's, I think, a core message that goes across lots of issues. So
I have maybe a concluding question. But I wanted to mention,
this is Alan Ridley, right?
This is Alan, yeah. But I wanted to mention that the indulgences could also be used for getting your relatives out of purgatory, or maybe getting them out of hell into purgatory. But anyway,
theoretically,
my concluding.
The Chinese have something like that called Joss paper.
Anyway, my concluding question is: well, so what is a hardworking person supposed to? How are they supposed to invest their money? What do you recommend? Where do they put their money? I guess you could say lumber and housing, but that's
well, that's what I could say if I had a crystal ball and had said it 2 years ago. You know, the lumber might come right back down, so it's all speculation.
Or own land with a lot of trees on it.
Yeah.
Okay. Well, thank you very much for an enlightening discussion and presentation.
It was a real pleasure.
All right, we will end this. Dan, you have to end.
Well, I just wanted to say, first of all, the Alliance for Just Money is, do you have the website name?
Yeah, it's monetaryalliance.org.
Okay. And also, if you Google Alliance for Just Money, you'll get it. And there's also a global umbrella group called IMMR, which is International
Movement
for Monetary Reform. And Alliance for Just Money is their main U.S. member, but they have members all over the world. And so those are the two groups, if you're interested in monetary reform, those are the two groups I most highly recommend.
I will say both of these groups have some very interesting coffee houses in which interesting guests are brought in who have expertise in various aspects of the money situation. So that's one of the things that I've found really, really stimulating. is those coffee houses. You have to be a member of the Alliance to join one of the coffee houses, but it's only $20 for a life membership. So I'd urge any of you who are interested to join the Alliance.
Yeah, and they do these, is it twice a month they have a talk on this?
No, it's once a month. It's
Once a month.
It's the fourth Monday of each month where the Alliance has its coffee house. And the international organization, I think, is in transition right now. And so they will be doing it, but I don't think they're doing it as regularly as the Alliance is.
Okay. And their hours will probably be not as convenient for Americans because they're heavily European.
Right.
Okay, well, I think that's it, and I thank you for explaining all this, and we hope to have this up on YouTube in a few days.
Great, yeah, let me know what the link is when you do.
Okay, thank you, and I'll see everybody next month.
17th of June, when we have Adam Schuster of the Illinois Policy Institute. This event will be co-sponsored by the Chicago School, Henry George School. So that's all set to run.
Okay,
Right.
thank you.
Bye.
Bye.
Good job.
Okay, bye-bye.